You know that feeling? It's almost midnight. You're staring at your bank account. The mortgage payment is gone, car payment's gone, and somehow, after a full month of working, you've got maybe a couple $100 left until the next paycheck. And the worst part? You own a house. You're not broke. You have equity. You have a job. You're doing everything right. But it still feels like you're underwater. Here's the thing nobody tells you. The system isn't broken. It's working exactly as designed. And most Americans were never taught how the system actually works. But today, I'm going to show you a completely legal financial strategy that some homeowners use to improve monthly cash flow, sometimes by several $100s a month. And yes, it can also temporarily create a mortgage payment gap for up to 2 months during the refinance process. No scam, no gimmick, no destroying your credit score. Stick with me, because by the end of this video, you're going to understand more about mortgages than most homeowners ever will. Let's get into it. First, let's talk about the real problem: credit card debt. Right now, millions of Americans are carrying high interest rates above 20%. That is brutally expensive debt. Here's what most people don't realize. Minimum payments are designed to keep balances alive for years. You make the payment, the balance barely moves. The interest keeps compounding. And over time, people can end up paying thousands and thousands of dollars in interest alone. Now, this is where homeownership changes the equation, because homeowners have something renters usually don't: equity. If your house is worth $350,000 and you owe $250,000, that $100,000 gap, that's your equity. And some homeowners use that equity through a cash-out refinance or debt consolidation refinance to pay off high-interest credit card debt. In simple terms, they move debt from a 24% credit card into a mortgage rate closer to 6 or 7%. That can dramatically reduce monthly interest costs. Now, important warning here. Credit card debt is unsecured debt. If payments become unmanageable, collectors can hurt your credit score and pursue collections, but they can't directly foreclose on your home. A mortgage is different. Your house becomes the collateral. So when homeowners roll unsecured debt into a mortgage, they are taking consumer debt and attaching it to the home itself, which means if payments become unmanageable long-term, foreclosure can become a real risk. That's why this strategy only works for disciplined homeowners who are serious about fixing the debt problem permanently, not temporarily. And one more thing. For some homeowners, the savings may only be a few $100s a month. For others carrying large amounts of high-interest credit card debt, the savings can be dramatically higher. It all depends on the numbers. This isn't magic. It's just debt restructuring and interest rate math. All right. Now let's talk about the part most people have never heard of. During a refinance, many homeowners temporarily go payment-free for several weeks, sometimes close to 2 months, without damaging their credit score. And yes, this is completely normal in the mortgage industry. Here's why it happens. Mortgages operate using something called interest in arrears, which basically means when you make your mortgage payment in August, you're actually paying for interest that accumulated during July. You're paying backward, not forward. Now, let's say someone closes their refinance on June 28th. The new lender immediately pays off the old mortgage balance, including the interest owed through that date. So June is handled. Done. Then the new mortgage typically doesn't require its first payment until the first day of the second month after closing. Meaning, if the refinance closes at the end of June, the first payment on the new loan may not arrive until August 1st. That creates a temporary payment gap. No June payment, no July payment. Now, very important clarification. This does not mean the interest magically disappears. It doesn't. The interest is still being accounted for within the refinance structure. This is mainly a timing and cash flow mechanic,
not free money. But for homeowners under financial pressure, that temporary breathing room can still matter a lot, especially if their mortgage payment is already several $1,000s a month. And here's something most people get backwards. If your goal is preserving upfront cash at closing, late-month closings are often more favorable. Why? Because lenders charge prepaid interest between your closing date and the end of the month. Close on June 5th? You may owe almost an entire month of prepaid interest up front. Close on June 28th? You may owe only a few days. That can significantly reduce out-of-pocket cash required at closing. And yes, this process is generally neutral to your credit score because the old mortgage is paid off in full and the new loan simply hasn't entered repayment yet.
Now let's talk about the part people really need to understand. Refinancing is not automatically a win. Sometimes it helps tremendously. Sometimes it doesn't. And the difference comes down to math. First, closing costs are real. Most refinances come with lender fees, title costs, escrow fees, prepaid interest, and other expenses. Depending on the loan size, refinance costs can easily reach several $1,000s. That's why the break-even point matters so much. Here's the question homeowners should ask. How long will it take for the monthly savings to recover the refinance costs? Let's use a simple example. Suppose refinancing costs $8,000 total, and after lowering interest costs and restructuring debt, the homeowner improves monthly cash flow by $800. $8,000 divided by 800 equals 10 months. That means the refinance may begin working in their favor after around 10 months. But there's another important detail many people ignore. Lower monthly payments do not always mean lower lifetime costs. Sometimes refinancing resets the mortgage into a brand new 30-year loan. That can reduce the monthly payment significantly while increasing the total amount of interest paid over the long run. So homeowners should look at both monthly cash flow and total long-term borrowing costs, not just the monthly payment alone. And if someone plans to move soon anyway, refinancing may not make sense at all. That's why understanding the math matters more than chasing hype.
So what should homeowners actually do before considering something like this? First, figure out how much equity exists in the property. Sites like Zillow or Redfin can provide rough home value estimates. Then compare that value against the remaining mortgage balance. Second, check your credit score, because refinance terms are heavily influenced by credit quality. Even moderate score improvements can sometimes meaningfully improve rates. At the end of the day, this video isn't about beating the system. It's about understanding how the system works. Banks already understand debt restructuring, cash flow timing, and interest rate leverage extremely well. Homeowners should understand those mechanics too. For some people, refinancing can meaningfully improve monthly financial pressure. For others, it may not be the right move at all. It depends entirely on the numbers, the timeline, and the homeowner's financial discipline.
And that's why understanding the math matters. Not hype, not fear, not TikTok shortcuts. Just math. See you in the next one.